This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high-yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX-listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing.
You've most likely thought of adding private equity exposure to your portfolio, but that comes with a lot of risk, especially when investing in earlier stage companies. But what if you could sit back, see how those private businesses have operated and advanced, and then choose to make an investment or not? That is exactly what my next guest, Eric Foran from the New York-based Coller Capital, does. Coller Capital invests in secondaries. This means they provide liquidity for people looking to exit private equity positions. This allows them to pick and choose what they invest in. They often use the analogy of betting on a horse race. Would you prefer to bet on the race right at the start, or would you prefer to bet halfway through after you've seen how it's all unfolded? I hope you enjoy this deep dive into the world of secondary investing in private equity and credit with Eric Foran from Coller Capital. Eric, tell me the Eric Foran story. Where did you grow up and what were your first experiences with investing like?
Sure. Well, great to be here. Thanks for having me. You can tell by my accent that I'm American. I born in Cleveland, Ohio. Grew up in Ohio and Tennessee. Went to middle school, high school, and college down south in Tennessee. And then moved to New York right after I finished college, joined Morgan Stanley right out of my undergrad, and have been within the financial services sector, both with a couple of big investment banks and within private equity now for the last 15 years. I took a pause during my career to go back to business school. So went to London Business School for my MBA, had a great experience, and during business school, got the opportunity to do an internship with Coller Capital, which is the private equity firm that I've been with for the last 15 years. That was my introduction. I got an offer to join full-time after I finished up school and came back to New York in 2010. And so I've been doing secondary private equity for the last 15 years. And I think this is going to be a fun discussion to talk about what we're up to and why we think this industry is so interesting.
Well, we first met when I was part of the Inside Network study tour over to the US in your offices. And that was really my first introduction to a word you've just popped in there, secondaries. So private equity secondaries, from a high level point of view, can you explain to our audience what they are?
Yeah, so when you commit to private equity, you're committing to something that is highly illiquid, right? You have to hold the investment fund for typically 10 years, at least, sometimes 12 or 13 years between when you make that original commitment, you experience the fund being invested, you experiencing the fund realizing the underlying investments, and then all of a sudden done 10, 12, 13 years after the fact. Now, inevitably, there will be moments in time during that journey where an investor may want liquidity. And so that's what secondary private equity provides. The founder of our business, a guy called Jeremy Coller, back in 1990, had the simple insight that when you commit to something illiquid, you may need liquidity from time to time.
That makes perfect sense.
It's as simple as that. And sitting here today, 2025, the industry is going to do over $200 billion of transaction volume. And that simple insight continues to be the driving force of the industry. Then on the investment side, if you're someone in our shoes, let me ask you a question. Think about your favorite sport. What's your favorite sport to watch?
Oh, this is left field, but I'm a big boxing fan.
Okay. All right. So a boxing match. Would you rather bet on the outcome of the boxing match before it starts? Or would you like to bet on the outcome halfway through?
I would like to do it halfway through.
And that's exactly what secondary private equity is, right? When we make investments, we're coming into the underlying private equity funds that we're buying in order to provide that liquidity to the underlying clients, typically 5, 6, 7 years after the original fund came together. And so our job is to look at the portfolio companies that exist within those funds today and come up with a price that we're willing to pay for the existing investors to take over their position in those funds. And so we've got a very big team that is focused on evaluating those companies, is focused on going out there and finding new opportunities. We are one of the biggest in the world doing secondary private equity, one of the longest standing investors in the space. Sitting here today, we've got $40 billion under management. We've got over 300 people in the business. We've got 75 investment professionals spread across London, New York, Hong Kong. And so we're a big business, but secondary private equity is all we do. It's all we've ever done. And within it, we do two things: private equity secondaries and private credit secondaries. And so very again, pleased to be here to get into the details of what all this means. But again, we've been doing this for a while and are kind of super excited to where the market is today here in 2025.
So Eric, I want to come back to your analogy of when do you want to bet on something, either at the start, before the jump, partway through, etc. In Australia, you can actually do that, right? You can actually... some of the betting agencies allow you to bet on games partway through.
Yep.
The issue with it is the odds change. So as a game progresses and it's a clear leader is starting to emerge, the return that you get for making that bet then decreases. So tell me about the return profile of secondaries compared to jumping in to a private equity asset at the start, when obviously, you know, the leaders are starting to emerge, like, hey, this is a good business, or this is a good asset. We want exposure to this. These people want to get out. You're coming in partway through, so surely the price implies those odds.
Yeah, so it's a great question. When you think about the alternative markets, right? You can think about different asset classes and different risk return profiles, right? You've got buyout, growth equity, venture capital, real estate, and secondaries. And secondaries private equity kind of sits in that landscape. And one of the great things about secondary private equity, given when we come into the funds, the volatility of returns is very low, because ultimately we have no blind pool risk. We can see all the companies that have been invested. We can price those companies based on what we're seeing in the macro environment today, how we think about those businesses, the growth of those companies, the current valuations, and where we think those companies are going to go over time. And what that means is that relative to all those other alternative investments, secondary private equity looks very compelling from that risk return profile. So we are up and to the left, which is kind of where you want to be. And that kind of narrowing of outcomes is driven by the lack of blind pool risk.
Can you explain blind pool risk?
Yeah. So when you commit to a private equity fund, you're committing to a manager who's going to take your capital and go out and make a bunch of investments. And some of those investments are going to work out really well. Some of them are going to be okay, and some of them may underperform. When we're coming in and looking at the portfolio, that underlying manager has already made all the investments. And we can observe kind of where those companies are today. And ultimately our job, and again, we've got a very big team doing this, is to look at those companies and come up with a price that we're willing to pay today for those businesses. One of the hallmarks of secondary private equity is that we buy things at a discount. And so when we think about the analysis of those companies, we're buying a set of cash flows, and we're going to solve for our return profile based on how we view the risk of those cash flows. And inevitably, that leads to a discount to the current fair value. And one of the metrics that you can see within secondary private equity over time is the data that shows in different market environments, what is the discount relative to fair value. Could be a 10% discount, could be a 20% discount, could be a 30% discount or higher, depending on where we are in the cycle, depending on how valuable liquidity is in that moment in time. And ultimately, these are negotiated transactions. And so if you are the investor and you wake up tomorrow and say you want to sell your private equity funds, you and I are going to enter into a discussion, and we're going to do a bunch of work on the underlying companies and do our diligence, et cetera. And then I'm going to come to you with a price that we're willing to pay for that. And either we agree on that or we don't. And so it's entirely within our control to make that transaction come together and figure out if there's an agreement on how we think about valuation.
So going back to something you said earlier, I believe you mentioned that the market for secondaries presently is about $200 billion.
Yeah.
Yep. That seems quite small compared to the market for private credit. Private equity, the primaries.
Yep.
So that power imbalance, so that size imbalance, does that put you in a beneficial position? Hey, we're here to buy your assets. You want out. We're here to buy them, but here's the price we're willing to pay. If you don't want to pay that, then you can feel free to shop around, but there's only $200 billion worth of assets in this space.
Yeah, it's so the $200 billion, just to put it in context, so for the last decade, the amount of volume that turns over within the secondary private equity markets has only been between 1% and 2% of all of the value that's held within private equity. And so that turnover rate, that secondary market turnover rate has never exceeded 2%. And so when people sit here today and say, okay, well, you're setting a new record in terms of transaction volume. This is a lot. Are we at a place where this market is becoming more mature? The market's grown a lot. And our view is that we, in many ways, are just getting started. Because if that band goes from 1% to 2% to 3% to 4%, 5%, you're still, only scratching the surface of, how much private equity turns over in the market. But the growth implications for secondary private equity markets are pretty enormous in terms of what that $200 billion could go to over time. And so we can be, here today, we can be very selective on ultimately what goes into our funds. So every year, we've got a very big team. I mentioned it, over 75 people out there looking for investment opportunities. We're drumming up over $100 billion of deal flow every year. We're going to invest 2%, 3%, 4% of what we see every year. And so we can still be in the place where we can be highly selective around what ultimately goes into our funds. And if you and I can't agree on a fair price, then it's very easy for me to move on to the next thing, as opposed to, tripping over myself to try to figure out and potentially overpay to solve the transaction between you and me.
Let's now look at some of those deals and firstly start at what makes a Coller Capital investment.
Yeah, so within secondary private equity, there's a couple of big types of transactions. There's a type of transaction called an LP-led secondary. So this is when, if you're a pension fund manager, right, you've been investing in private equity for the last 10 or 15 years, you wake up tomorrow and say, I want to liquidate $500 million of stakes in private equity funds that you've committed to over the years. We'll come in and help solve that problem for you. And we'll come up with a price that we're willing to pay you for that $500 million portfolio.
If you want that portfolio first.
Yeah, if we want it. And of course, we're going to do a bunch of work, and we're going to do a bunch of work on the underlying companies. And we're going to figure out the price that we're willing to pay you for that transaction. So that is the traditional secondary private equity market.
Buying chunks of existing funds, so multiple businesses within these funds.
That's right.
And you're doing your due diligence on every single business within the fund.
Exactly.
Yeah.
Exactly. And so again, we're typically coming into year 5, 6, 7 from when those underlying funds started investing. And so you can imagine that transaction could be 15 funds, could be 25 funds, could be 50 funds. Within each of those funds, there's a whole bunch of portfolio companies. So those portfolios tend to be very diversified from a vintage perspective, geographic perspective, strategy perspective. Now, we're mostly buyout, but we might have some growth equity in there, et cetera. And so the again, we talked about risk return already. You can imagine that when we're underwriting that portfolio, the sheer diversification that exists within that portfolio looks pretty good. And you have no one particular area that could cause things to go sideways. So that's the LP-led secondary market. Sitting here today, that's about half of the overall secondary market. The other half of the market today is working with private equity managers to offer their investors liquidity from existing funds. And so today, there might be a single company that a manager wants to own longer, or might be a portfolio of companies where a manager wants to kind of own those businesses for 3, 4, 5 more years. And so in order to do that, we'll set up a new fund to buy those companies or that company out of the existing fund, to give the investors in that original fund a liquidity option. So if they want our price for those companies, they can take it. And if they don't want it, they can just roll over their exposure and maintain that exposure to those companies going forward. So that's called a GP-led secondary. And that's the other half of the secondary market today. And I highlight that, or I highlight both of those, because Coller's approach is very active in both. And so you asked about how we approach investing. We've got a very big business that focuses on both parts of the market. We think they're complementary. We think that having our funds invest in both provides a nice combination of diversification and early cash flow coming from the portfolios that we're buying on the LP-led market, coupled with the higher money multiple but slightly longer duration that comes with taking more concentrated exposures to companies via the continuation fund GP-led secondary market. And so when we think about transaction sizes for Coller on the LP-led portfolios, we'll do $200, $300, $400 million portfolios on average. We can go a lot bigger if we want to. We can also go smaller if we have ready pricing on a particular fund that may end up being on the small side. And then on the GP-led secondary market, those are a little bit more concentrated, and so we'll go. The numbers are the same, so $200, $300, $400 million, but those could be to a single company. Could be to a much more concentrated portfolio of companies. And so the way we diligence those opportunities, given the company sizes that we're investing in, is much deeper than what we're doing over here on the very diversified LP portfolios. We manage some very big drawdown funds. So kind of a traditional fund structure where investors commit to a 10-year fund. And in those funds, kind of have a split 50-50, 60-40 between these strategies. And today we also manage a few evergreen vehicles. And so perpetual funds where investors can commit to the evergreen strategy. And the same is true. We'll have a slightly different balance between the two strategies. But those are the pools of capital that we manage today that are participating in both parts of the secondary market. I'm
interested in those evergreen funds, but I just want to ask one question then. Coming back to that, what does a Coller Capital investment actually look like? I get the sense then you're relatively sector, industry, etc., agnostic, and it's more about the opportunity. It's about the broader opportunity set, the price that you can get for it, etc., and how it fits in with the overall fund. It's not, hey, we focus on tech, we focus on this. It's more, take more of a holistic kind of approach.
Yeah, thanks for circling back there. So it very much is that dynamic to some degree, right? We have to be in the position to solve the liquidity problem for a counterparty who may own a whole bunch of things. Yeah. And so we need to be able to price a whole bunch of underlying types of companies, a whole bunch of underlying types of risk. That being said, we are mostly buyout. When you think about the underlying investments that we're buying, it's mostly buyouts. When you think about the geographic exposure, it's mostly U.S. and Western Europe, right? These are the biggest parts of the primary private equity markets. And if you think about, we're just a derivative of the primary private equity markets. And from a sector standpoint, we are pretty pretty agnostic because we can price pretty much everything. But over time, as we're investing our funds, we're paying close attention to the portfolio composition and how the portfolio is coming together. And so there may be moments in time where, we have a lot of exposure to a certain sector. Maybe it's technology, maybe it's healthcare, where we're not going to turn off the tap. But we might say, in order to do more in a particular sector or a particular geography, we just demand more return to add that to our portfolio. And so
you're wary of it, of that portfolio construction.
Exactly.
I'm curious then about how the team operates.
Yep.
75-ish investment professionals there. Do they all fit into industry or sector specific specialities, or are they more generalist as well? How do you operate that team?
Yeah, so we're mostly generalists with a little bit of specialization sprinkled in. So you can imagine the senior team, the day job is going out there, originating opportunities, finding the investment opportunities, maintaining relationships with the big owners of private equity, with the big private equity managers within the space, to make sure we're top of mind when an investor needs to generate liquidity.
I was going to say that relationship side of things must be so important to you, because you have to know who's got what and when they might want to have that liquidity moment happen. And I'm sure that even though it's a small industry, it's a competitive one, I'd imagine. And so you want people thinking, hey, I'm going to give Coller a call.
Absolutely. We want to be top of mind. We want to be in a position to, again, solve the problem, understand why that person needs liquidity, why the organization needs liquidity, what are the motivations, what is the real issue, right? And so the secondary market can be very creative in deal structuring. And so it doesn't necessarily just need to be, I'm going to pay you $100 for your portfolio that's currently worth $120.
Can you, tell us about how creative they can get?
Well, the sky's the limit in some cases. No, we can be very involved in evaluating a portfolio. If there are assets inside that portfolio that we think are dilutive to the price, we can exclude those. If we like certain things,
so you can exclude certain assets within the portfolio. Hey, we love 80% of this, but hey, this little chunk, not for us.
Yeah, we could exclude it completely. We could price it appropriately, and maybe that price is zero. And maybe that price is a very deep discount relative to other parts of the portfolio that aren't. And so that it's entirely within our control to have that discussion with a counterparty. What is the real size of the liquidity issue that you have? What is your real threshold in terms of where you want to transact? Do you need the cash today, or can you deal with some of the cash today and some of the cash 6 months from now? Are you open to financing arrangements, cash flow sharing arrangements? So there's lots of different things that we can have a discussion about. Now, inevitably, some groups, all they care about is price and getting the highest price possible and getting it all in cash up front. And that's perfectly fine. And if I had to think about sellers in our market, the U.S. pension funds have that mindset most often, where there's gonna be a banker that's likely involved. And I talked about that we've got a big team that's out there finding the opportunities. That being said, like most markets, there's also a big advisory community out there that are advising asset owners that are running sell-side processes, auction processes, to bring these portfolios through market as well. And you can imagine that there are some investors that have to hire a banker to go run a big process. And of course, we're going to see all that deal flow. And then there are some types of investors who don't. And we can have one-on-one discussions and real bilateral conversations with them about what we can do to solve their problem. And those are really good conversations to have as well.
This is probably going to be a how long is a piece of string kind of question. But I'd imagine then, given the complexity that can be involved in some of these deals and the back and forth, how long does a deal usually take to take place?
Yeah, so on the LP secondary market, something will come onto our radar. We may take 2, 3, 4 weeks to come to an initial view on value, depending on how much additional new work that we need to do. So we have ready pricing on north of 80 funds. Every quarter we're updating them. We're staying current on the underlying companies, and so we can come up with pricing pretty quickly on a whole bunch of underlying assets, but we'll have a period of time to come to an initial view on value. Then we'll have another couple of weeks to firm up our diligence and come to a final view on value there, and then get the transaction kind of executed and wrapped up maybe a month after that. I would say on the other part of the market, the GP-led part of the market, the timeline's a bit longer, right? Because the level of diligence is a bit deeper. We're working with the incumbent managers, with their deal teams. We're meeting with the management teams of companies. We're doing getting third-party diligence reports and all of that type of thing. And so that's going to take longer to come to an initial view on value. And then the next phase of kind of firming up our diligence, confirming everything may take, a month, 4 or 5 weeks. And then the legal and closing phase of that transaction, could run another 5 or 6 weeks. And so one of the concepts of secondary private equity is that we value everything off a reference date. And of course, there's lots of things that can occur between the reference date that we're pricing the transaction off of and when we ultimately close the investment. And in some cases, that could be 3 or 4 months. In some cases, that could be 6, 7, 8 months. And we're able to kind of see how the underlying portfolio is progressing over that period of time. And so by the time we're ultimately making the investment, there's been a nice amount of time between the value that we ultimately priced initially, which is a nice characteristic of secondary private equity.
So how do you judge internally if your team's doing a relatively good job there? Because you'll have some investments that do incredibly well. They'll exceed that.
Yep.
But then, of course, you'll have some that don't do so well. You may have some that are materially less than that.
Yep.
How do you think about that internally there?
Well, I mean, ultimately, the report card is the returns.
Yeah.
It's the track record, and so that's the ultimate report card. That's what our investors see. That's what we use when it comes time to having the conversations to re-up and recommit to our funds over time. And we're very proud of the track record that we've created. That's a result of a investment philosophy, investment approach, underwriting process that has been developed and fine-tuned over 35 years. And that's one of the benefits of having done this a while. We've seen a lot. We've seen a lot of cycles. We've seen a lot of types of assets. We've seen a lot of things go really well. We've seen a lot of things go really sideways across the industry, and so we can constantly be looking at how we can improve our craft. And if we weren't, that'd be a bad thing. But I would say, sitting here today, 2025, we're probably doing our craft better than ever because we're constantly looking ourselves in the mirror and thinking what we can do better. And I would say today, big focus on portfolio composition as we're building up a portfolio, how that's coming together. The underwriting process has been, again, refined over a very long period of time, and ultimately the output from all of that is what leads to that track record that we're so proud of.
Given the history and how long you guys have been at this for, it just came to mind. I know as equity investors, when the market pulls back dramatically, when we have a correction or even a crash, it's a fantastic time to go shopping. Mm-hmm. Where analysts are skipping to work, or value-based analysts are skipping to work. During periods like, say, the GFC and, say, more recently, COVID, mm-hmm. Are they periods of time that it's ripe of plenty of opportunity for Coller and secondaries, or do the deals kind of dry up because people don't want to be, like, say, selling at significant discounts? Yeah,
great question. A little bit of both. And if I think about Well, even think about more recently. So, rewind the clock, 2021, right? Markets were ripping, frothy valuations.
Coming out of COVID.
Yeah, rates were still, in fact, money was free.
Money was free. Government was handing it out.
Exactly. And so there was a lot of froth there. Subsequently, right, we entered in that 2022, 2023 period where rates spiked, valuations came down, regular exit markets pulled back, and liquidity became something that was really important to find because it didn't exist in the regular way. And so that environment, that 2022, 2023 period was a great time for secondary private equity to be there to provide investors with that liquidity, right? Because you can imagine, big institutional investors, family offices, even high net worth investors, they commit to private equity with a certain expectation around the capital call and the capital distribution profile out of that portfolio. And so when you have markets like 22 and 2023 where distributions dry up completely, all of a sudden investors are saying, well, wait a second, I don't have the liquidity that I thought I would have in order to fund either my operating budget, my operating expenses, or reinvesting into the portfolio. And so we were there to solve that problem. And so to kind of loop back to your question, inevitably the bid-ask gap does widen out in the early moments, right? Because we have the benefit of reacting immediately to changes in the macro environment, to changes in the financial markets, and we can change our price that we're willing to pay for a certain asset overnight, effectively. That being said, investors in private equity get a statement every quarter that says their investment is worth X number of dollars. And so you have this dynamic where that bid-ask gap does widen pretty early on in moments of volatility and dislocation, and that does lead to a pullback in activity, for that reason. For Coller, we deployed just over $1 billion in that 2023 market at returns that were way too good for the underlying risk that we were buying, which was fantastic. I wish we could have deployed $3 billion, right? And so that's the kind of dynamic that we were seeing. And then if you look at the last couple of years, 2024, 2025, again, 2024 record year for secondary private equity. 2025 will exceed 2024. This is that ongoing liquidity-driven growth in the market, but that bid-ask gap has narrowed a bit, and expectations have been buy-side expectations, sell-side expectations have been more often meeting in the middle, and that's supporting a healthy amount of volume.
I'm thinking from a layman's point of view. I'm not an institution, clearly. I'm just an individual investor. How can I get a gauge of where that big bid-ask spread is, and where that liquidity, what that kind of liquidity looks like at any one point in time? Was it quite obvious during that period that liquidity was drying up? What are some telltale signs for the enthusiast, reading the Wall Street Journal and whatnot?
Yeah, I mean, the thing that you'll be able to find, and anybody can find as long as you kind of look in the right places, is the market information on discounts relative to NAV, and where the secondary market is pricing overall. That's observable information. There are very credible bankers that are publishing reports twice a year, some more frequently, that just talk about where the market is from a discount perspective.
Who are those bankers?
Some of the big bankers in the space, Evercore, Jefferies has a big business, Morgan Stanley has a business, Goldman Sachs has a business, PJT. So there's lots of groups that operate around the market that publish reports around what's happening within secondary private equity. Of course, we publish our own stuff too. And I think we actually have a lot of information on our website, white papers, videos talking about the market and all that kind of stuff.
So you'll be, if in that kind of scenario, when you're seeing that happen, it's in your best interest to let people know, going, hey guys, like, we are seeing opportunity here.
Yeah, and of course, with our investors and the people that we're closest to, we are talking about these trends very openly to make sure people are aware of how we are viewing the investing environment at any particular moment in time. You can imagine we spend a lot of time talking about our pipeline, talking about the opportunity set, talking about how we're underwriting new investments, the discounts that we're seeing in the market for the different types of underlying private equity funds. So all of that stuff, we live and breathe this stuff, and we are constantly educating our investors and our prospective investors around the dynamics of the secondary markets. But there are some other third parties as well that are doing the same thing.
Where are the dynamics sitting at the moment? I generally don't like to date episodes, so they're evergreen and people can jump in and out. But I'm just now really curious now that we're talking about it. Is it how's it sitting at the moment? I feel it's maybe a kind of the middle ground.
Yeah, I would say that one of the questions we get is if you think about the world of private equity, some of the world's biggest private equity funds, full stop, are secondary private equity funds, which hasn't always been the case, but there's just been a lot of tailwind within our industry, and the recognition that being that provider of liquidity when there isn't any liquidity is actually a pretty good idea. And so there's been a lot of interest in the asset class, but at the same time, there's been a huge growth in the underlying market, which we've already talked about. And so one of the metrics that we track is, well, how much money is out there chasing the opportunity set? And sitting here today, that supply-demand balance is pretty good. And it's in a pretty good place. And it's actually been pretty consistent over the last 10 or 15 years. And while more and more capital is interested in secondary private equity, the growth of the underlying market has been remarkable. So that's one thing to look at in terms of setting the scene on where we are today. And then in terms of buyers and sellers meeting common ground, we're kind of in the middle. Like I would say that we still are playing an important role as an industry to provide liquidity when there isn't any. And so in that sense, maybe the pendulum is more in the buyer's favor to some degree. But 2021 was the opposite in that, given all that frothiness, and then 2022, 2023 was the other side. And so I would say the pendulum is probably a little bit closer to the middle, maybe a little bit on the side of buyers.
Just a real quick question on how you see your clients using secondaries in their portfolio. Is it alongside private equity? Are they actually investing in primary private equity plus secondaries, or are they seeing secondaries as just a better way to play that asset class for that sleeve of their portfolio?
Yeah, so I tend to see secondary private equity play three roles. Investors think about it in three different ways. The first way is that kind of core part of a sophisticated asset allocation to private markets, and secondary private equity plays a core part of that, and either maybe the only part of that, or maybe sitting alongside buyout, growth, venture, et cetera. But it's a core part of the program that cycle in, cycle out. This is in the portfolio. What it offers from a diversification standpoint, J-curve mitigation standpoint, risk return standpoint, makes a heck of a lot of sense just to be there. The second area is investors who are getting into private equity for the first time. Right? There's a family office has had a liquidity event, or the portfolio is now coming into alternatives for the first time. This is, again, a great way to do that because you get the immediate benefit of the diversification. If you're going to kind of take that step into alternatives, this is a really nice way to do it. That's been the case for a really long time, right? 15, 20 years ago, as the big institutional investors were getting into private equity for the first time, they were committing to secondary private equity to do that. The third area are the tactical folks which I think is really difficult. But for people that say, I think a particular vintage is going to be very compelling to commit to secondary private equity because I think liquidity is going to be super valuable and we can get an excess return by being that liquidity provider. So I'd say in my observation, the percentage of folks approaching it in those three different areas goes in that order. And today, now with our evergreen funds for an enormous universe of clients who may have never had access to private equity secondaries before because the drawdown fund structure wasn't appropriate for them, having this be a core part of the private equity allocation is really resonating for all the characteristics that I talked about.
We're going to get a little bit lighter now because we're just wrapping up and there's always two questions.
Okay, go on.
That we ask. You told me you'd skimmed a few of my questions. I'm not sure if you got down to this point. Your eyes tell me you did not. So there's a question that my colleague Owen always asks of guests when they're on their first episode. And there's a question that I always ask. So Owen's one is, if you could go back in time and tell a young Eric Foran something about life, business, investing, etc., what would it be?
You're right. I didn't get all the way down to the bottom of the page here. And so my reaction will be in the moment.
It's got to be natural.
Which is going to be natural. So, I mean, what I think of immediately, have fun. Have fun. I mean, people, they're starting their careers in the financial markets. There's a whole different range of ways to get into a career in investing and private equity and investment banking and all of that stuff. It's difficult. It's hard. It can be stressful. You work long hours. You get stressed out a lot. The advice would be to take a step back and just have fun with the journey. Relax a little bit. Yes, it'll be a bunch of hard work. Yes, it'll be stressful, but try to kind of step back and appreciate the work that you're doing in the moment. The other thing that comes to mind probably is just embrace risk and embrace I'm not talking about investing. I'm just talking about in life. Be open to doing the different thing, like being uncomfortable in a career choice or being, uncomfortable in maybe in a room or in a meeting or something that, may not be comfortable for you to have the loud voice or share the dissenting opinion. Just be open-minded to that kind of stuff.
I like it. Now, my one is the out of office is on.
Okay.
Me and you are going to lunch.
Okay.
Could be anywhere.
Okay.
Where are we going and what are we having?
So unfortunately for you, this is going to require a long flight because the out of office better be on for a couple of days because I'm going to get you to come to New York. I'm a New Yorker. I live in the city. We're going to go to a New York Mets baseball game.
Right. I went to a Red Sox game. That was fantastic. So
I won't hold that against you. I promise I won't. And we're gonna have a ballpark hot dog and some of the good food there.
Fantastic. So. I didn't actually have a hot dog when I was at the baseball. Okay. So I'm going to take you up on that offer. Fantastic. Eric, I really appreciate you stopping in on your little Australian roadshow and talking secondaries with us. I really appreciate it.
Yeah. Well, thanks for having me. Super excited about the presence that we have in Australia now. I've got a couple of colleagues who are based here. You can probably tell that I love this stuff. I live and breathe this stuff. Very excited around where the market is today, and just appreciate you having me in for this discussion.
Excellent. Okay, Eric. Enjoy Melbourne, and we'll catch you soon, hopefully.
Awesome. Thank you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.